Guys, thanks for watching. My name is Ben. So you've been thinking about the stock market, eh? You ever had that friend or cousin who's always talking about their investment portfolio, and you ever wonder, maybe that's something I want to get into as well? You've probably also heard of people talking about day trading or investing for the long term. All these terms come up, but how the heck am I supposed to know what the difference is? In today's episode, I'm going to be going over the difference between stock market trading and stock market investing and how each of them can benefit you. I'm going to let you decide which one works better for your lifestyle. Let's look at the stock market first. You're buying shares of a company, and you're essentially betting that this company is going to do better over time, and so you can take your shares and sell it for a profit. Because the stock price fluctuates every day, every minute, and even down to every second, profits and losses can be made constantly. If you're a day trader or a swing trader, you're looking to buy and hold a stock for a day, so a day trader, or for multiple days and multiple weeks, swing trader. We call this trading because people aren't really invested in the company. They're looking at the price action charts, looking for patterns to see if they can make a profit off a small increase in price. Sometimes as little as 1 penny can make a big profit for someone. For example, let's say you buy 50,000 shares of a $10 stock, and that stock goes up by 1 penny. You can make $500 from that trade, but you're also risking $500,000 for that $500. People compare trading to gambling at the casino. However, with trading, you can almost count cards in the stock market. There are many indicators and historical trends and patterns that can give you an edge when you're making an educated probability guess that will give you a slight advantage. It's almost like you can go and count cards and blackjack, except you won't get kicked out of the casino. Also with trading, each penny can mean you're up or down hundreds, if not thousands of dollars. You have to be able to react quickly in order to take advantage of any price movements. Trading also requires a lot of time watching the market during when it's open, which is open from 9:30 to 4 o'clock Eastern Time. That can be potentially a full-time job for someone every day, Monday to Friday. You can be hugely successful in trading though. You can potentially make a full-time income trading 1 to 2 hours per day if you do it really well. However, it does take a lot of time studying the market, understanding the strategy, and building patterns so that you can enter trades and exit successfully and earn an income that way. So the pros to trading: can skip the downtrends and move money around for bigger gains. Gains can be upwards to double or tripling your money, while average yearly investment only nets you around 7 to 10% if you invest in an ETF like the S&P 500. Can also make enough money to support you as a part-time job, sometimes only requiring 1 to 2 hours of trading per day. It's much more flexible, as you can often have cash instead of any stocks, and you can move capital around freely. Cons to trading: may have to consistently think about it, as penny changes can be very drastic for your portfolio. Almost daily active management of your portfolio. Very easy to lose money if you're emotional on your trades. Can be very stressful given the combination of all these aspects. You can be focused on only a handful of companies because you don't have enough money to go around. Not very diversified and much higher risk. Investing, on the other hand, can be much more passive. Most people either buy into individual companies long term, or they buy into index funds. Index funds are essentially baskets of companies in certain sectors like tech or pharmaceuticals. Index funds allows you to put a little bit of money in each company in that basket. Therefore, it spreads out all your risk. So even if one company goes bankrupt in that basket, your money is safe with all the other companies, and you'll only lose a small portion of your portfolio. For example, the S&P 500 is a combination of the top 500 biggest companies in the United States. So that if you put your money into the S&P 500, you know that your money is moving along with how the state of the economy is moving along. You'll know that your money is safely locked in with how the economy itself is doing. By diversifying your risk in the market, you know that you can sleep well at night, knowing that you won't wake up in the morning and lose all your money. With the investing method, you're putting in your money for the long term, 5 to 10 to 20 years. It's about averaging your risks with each company and with time itself. For example, in 2008, the S&P 500 lost almost 50% of its value. However, 4 years later, it climbed back up and exceeded its previous expectations. In the long run, the market gains approximately 7 to 10% per year. And that's without you having to have much understanding about the market and the economy itself. Obviously, there are years where the market drops tremendously, but that's where the factor of time comes into play. The longer you have your money in the market, the more guaranteed your returns are because it has more time to regrow and regain all that has been lost. Lastly, if the stock that you pick pays you dividend, then you'll get a small income every quarter when the company pays you a small part of their earnings. You can take those earnings and reinvest it back into the same company or another company and compound your growth that way. Over time, your portfolio will grow because you're averaging out your risk and you're compounding your money by putting it longer term in the market. So here are the pros to investing. You don't need much skill or understanding of the market, but you can put it into safe baskets of companies such as index funds. They're low stress and you don't need to be checking in on it every day and every minute. You can diversify your risk in the market and so you won't lose all your money. Your money will grow with the economy. You can average steady, consistent gains given that market growth and your time spent in the market. The longer time you spend in the market, the more consistent your growth will be. The cons of investing is that you'll get a small percentage of gains compared to trading. Percentage-wise, usually 7 to 10% per year. You'll need to hold on to losses, as not every year the market does well, and you'll have to endure years with losses and not panic sell. Your money is locked up, especially if the market is down and you don't want to sell, you don't want to lock in those losses. In the end of the day, the smartest way to go is to make sure you participate in the stock market and let your money grow more money for you. In both methods, you'll need to learn different strategies to manage your money. So the smartest way to go is to continue to learn more about the economy and to educate yourself about your finances. So in the comment section below, let me know what you prefer. Do you prefer investing? Do you prefer trading? Or maybe a hybrid of both? Let me know what you like and what you prefer and why. But make sure you smash that like button, you hit that notification button, and make sure you subscribe to my channel for more future videos. And we'll see you next time.